I want to start by asking you this. If you were on the FOMC, well, always great to have you. If you were on the FOMC, and you, I think, always were sort of in the center, you could kind of listen to Dennis Lockhart and know what the Fed was really thinking. Would you really agree? Would you be a little bit more concerned about the fact that inflation is falling?
Again, I didn't quite get that. I'm sorry.
Inflation is falling. If you were at the Federal Open Market Committee, would you have maybe expressed a view that was maybe a little more cautionary, maybe saying, hey, if this continues, we may have to do something like cut interest rates?
You know, I think people can overread the situation. Jay Powell today in his press conference was really direct. They think policy is set at an appropriate level. They are in a wait-and-see mode, I think, for the foreseeable future. I would be surprised if there's much of a move in terms of policy, perhaps for several months, unless you see a real change in how the economy is performing.
But, you know, the Federal Reserve has this 2% target, and they have said that the aim of policy is get to their 2% target. If inflation's falling and you don't respond, does that kind of put the Fed's credibility on the line? Does it kind of lend credence even to President Trump's criticisms and other people's criticism that the Fed is not responding as it should?
Well, you know, there's certainly a lot of noise around Fed policy these days is coming from political circles and such. But in my experience, they will do everything they can to almost totally ignore the pressures that are coming from either the White House or from other people in the political arena, and simply keep their focus on what they think their job is, and that is to set policy in a totally nonpartisan, apolitical way, and to make their decisions based on evidence, based on the data. I was there for 10 years, and so I went to some 80 meetings over that period. And that is the MO of the Federal Reserve. And I think they'll do everything they can to simply stay the course and do it the way they have always done it.
If inflation stays so far below target, would you think the Fed is in a position where it should cut interest rates, Dennis?
I would not. I really don't expect an interest rate cut in the foreseeable future. However, they are focused on inflation. The major variable today that I think will influence policy is inflation. They're extremely satisfied, as they should be, with the employment situation. So of the two objectives, it's inflation that's perhaps the more in focus or the more concerning. And I believe they're focusing not only on the monthly inflation numbers, but also watching inflation expectations very carefully. And if they detect that inflation expectations are really anchoring, you say at 1.5% or lower, or that the public is really beginning to believe that there's no such thing as inflation, or at least nothing close to their 2% target, then they may feel the need to move. Also, of course, if we saw recessionary conditions develop, they might move for that reason as well. But neither of those descriptions is really apt at the moment. So to come back to something I said a few minutes ago, I think they're in a wait-and-see mode.
Sure. So let's look at the economy, Dennis. We did get the Institute for Supply Management's Purchasing Managers Index today. It remains above 50. That signals expansion, but it's been coming steadily lower as well. And I think if you look inside, that's what's also very significant. Outputs pulled back. New orders have come down sharply in the latest month, and new export orders now are below 50. We've seen this global slowdown in manufacturing, at least the picture painted by the Purchasing Managers Index. How concerned are you about that when you look at the global economy and someone who enjoyed, before you went to the Fed, a long career in international banking?
Well, the PMI is of course, one data element that is important, and it tells you something about how a sector in the economy is actually performing, and it may give you some indication of what's to be expected in the future. But a lot of these monthly indices are noisy. They jump around a little bit from month to month. And I don't think one read of one index is necessarily going to influence their thinking. If you go back just a few days, we were talking about really the very strong first quarter growth number, the GDP number. I think today in their in Jay Powell's press conference, and also to some extent in the statement, they acknowledged that the momentum of the economy is solid. If you look inside the GDP number, the consumer and investment numbers were sort of at the longer-term trend expected for the economy. So that number was influenced by inventories. They really have to take in a whole variety of indicators and then draw a synthesis from that. So the PMI alone is not going to sway the question, I think, for the FOMC.
You know, Dennis, the Fed is undergoing a big rethink, re-examination of its policy framework this year. And of course, one of the two key elements is that 2% inflation target. Is it time for the Fed to maybe acknowledge that inflation has changed, Phillips curve is, if not broken, real flat, and maybe it's time to move away from a 2% inflation target, put more flexibility back into policy the way it was, say, during the Greenspan years, where the goal was price stability and inflation came down very nicely without a 2% target?
They do have a review underway. My understanding is that review will culminate in the middle part of the year, June, July. That in many respects, that review is the end of the beginning of a process that will take probably several more months. And they could change their approach to inflation from a let bygones be bygones approach to an approach in which they would make up for past undershoots by trying to overshoot for a roughly equivalent period of time. But as far as I can tell at this time, these are just ideas that are being discussed. They're far from making any decision on this, and I think it's probably equal odds that they would change their approach versus just stay with the symmetric approach they have today and just continue to try to achieve something around that inflation target.
So, Dennis, when you look at the global economy, particularly U.S. China trade war, there seems to be a lot of hope, a lot of bets riding on getting a deal soon, eliminating uncertainty for businesses, for consumers, and we'll see a pickup in the U.S. economy, in China's economy, in everybody's economy. What do you think is going to happen there?
Well, there are some somewhat encouraging signs, and if you recall early in the year, the FOMC and Chairman Powell were talking about cross currents in the economy. I think he mentioned that, used that word in today's press conference, and really referred to the concerns they had in the beginning of the year. And he said, and I agree with him, that some of those have abated a little bit. The circumstances have improved in the global economy. The situation in your part of the world there in Asia, it seems to be stabilizing a bit in the enormous Chinese economy. The U.S. had a very solid first quarter and can expect, I think, a continuation of solid performance. So I think we might breathe a little bit more easily now at this stage in the year, that the momentum globally as well as in the United States is likely to continue.